Hey everybody, welcome to the morning market briefing. It's Tuesday, August 4th, 2026. Hope you're doing well out there. A little traffic situation. Schools are back. Chaos ensuing. Super producer Hicks, 20 minutes of traffic. Tough times. But he's
But
here.
still half an hour early.
Still here in plenty of time. Seems like the volume is working, which I think is a favorable bit of feedback. I did hear from one super user over the weekend that was very concerned about would Hicks actually be welcomed back or was he terminated? But he's back. So was back yesterday too. I was not back. So let's jump in. Ben, ISM Manufacturing, you used the illustration of a train picking up some steam and rolling forward last week or the week before. That certainly seems to be the case. And it seems like this thing's going to be quite difficult to derail.
Yeah, everything is coming up roses right now for the industrial side of the economy. The real question now becomes is this strength? Is everyone feeling this strength, or is this crowding out from the data centers? We talked about last week the gentrification of memory chips. Are we seeing the gentrification of industrialization? And by that I mean all of this capital is being used for data center applications rather than other applications like construction or residential construction, because that is the highest and best use. We use the illustration of how if you see a gentrifying neighborhood, all of a sudden that real estate is more valuable to build a nice home or an apartment complex, or Truist Park. Now a hotel makes sense where a lumber yard may have made sense before. And the question is, now is the highest and best use of all this industrial equipment only in the data centers, which is making it more expensive for other people to build, apartments or homes or things like that. And so that's a question that remains out there. But right now, I don't know if that's the case. I think it's actually a fairly broad development that's led by data center. But I think the whole industrial side of the economy is broadening out and growing. You're seeing that in aerospace and defense. Aerospace and defense is growing fairly rapidly. In fact, one company with an end market in machinery in the ISM survey said defense is at an all-time high. Most of our products is going to these two industries, defense and data center. They say that medical, industrial, and consumer products are lower, but I'm seeing from other people, including United Rentals, saying that we are seeing some broadening out there. So that remains an open question, but the headlines are, at large, in aggregate, industrial demand is strengthening. You're seeing that in new orders. You're seeing that in employment. Employment expanded in the manufacturing sector.
First time in almost 3 years.
Unbelievable that it's been that long, really. I mean, when you think about it, when you think about how the market is done and how the economy is done over the last 3 years, and the fact that we've had shrinking employment in the manufacturing sector for that period of time, according to the survey, that is remarkable. And importantly, prices coming down just a little bit. Not as much as perhaps I might have wanted, but they did moderate in July relative to June, which is a good piece of news. And Scott Bessent was on CNBC earlier. He was talking about underlying inflation remaining relatively subdued. I would have some sympathy for that argument as well.
We've talked about the bouncing ball of the AI movement and how quickly these trends seem to change and what comes into favor and how much those stocks will move. But I would argue to the listener that, as we think about how much is the data center story coming to play, even on ISM manufacturing data, how much of the industrial economy is dependent on it, perhaps there's no better read through on the breadth of recovery and strength than actual earnings reports outside of, the hyperscalers and things like that. We've continued to see pretty solid earnings. Been curious on the industrial side. Are there earnings that stand out to you as worth taking note of?
Yeah, there are a couple. Today we had some interesting ones. So TransDigm, which is a supplier to the aerospace industry, really aircraft, they did fairly well. But Cummins was somewhat weak. They have a big end market in the trucking space, and they saw improved demand. They raised guidance for the year, but the stock's down pre-market. Caterpillar is probably emblematic of this kind of confusing market. They had power demand that was up 75%, and that really led the growth for Caterpillar. But at the same time, they're talking about a fairly broad industrial demand that, again, is led by data center. But because you can't really parse that out, I mean, their industrial segment was down 8%. So it's difficult to know if that's just that's being reallocated from industrial to data center, because that's the shark closest to the boat and that's the demand they need to fill. Or if it is really weakness in more traditional markets and strength elsewhere. So Caterpillar raises a lot of questions for them themselves. It's all good. But as it relates to the broader economy, I think is a little bit more uncertain.
Yeah. Does it make you long term? Do you think this is maybe almost like Corning, where you get a big pop, they're making a ton of glass and fiber optics and all these things that are sort of outside what people would normally think of their business, and now they're getting crushed this month? Because notably, Michael Burry announced that he was short Caterpillar. He's taking it on the chin today, but could that potentially be something to look out for long term?
Perhaps, but I think Caterpillar's end markets are more, yes, they're cyclical just like Corning's end markets are in display glass, but I think Caterpillar is going to see some more demand, some more durable demand. I think that what we're seeing, all this capital is being raised and has been raised on data centers, and now I think you're starting to see it really come to market. You're seeing that growth in the power semiconductors as everything gets connected. You're seeing that growth in the optical fiber companies, but Caterpillar, especially on the power generation side, is doing exceptionally well. But they're also doing well in resources, so mining, and even locomotives, doing really well there. I think their sales were up 170% or something in trains. Small part of the business for them, but nevertheless significant. So I think data center infrastructure is really improving. We're seeing that across the board, and I think that's certainly benefiting Caterpillar among a number of other companies that are moving significantly this morning.
Palantir moving a lot, up 15%. Is it still holding there?
Yeah, and I think it was up 17 at one point. What's very interesting about Palantir is they said we don't get paid for clicks or tokens or chats. The gamification of the most significant development in modern economic history seems to us misplaced. The limitations and faults of the token industrial complex threatens the world economy, and it's been increasingly exposed. I think this is very interesting because we've talked about this a lot, the tokens and the costs, and Palantir says we only get paid for results. Which, I mean, I think Palantir is an exceptional business, and they're growing exceptionally well.
The only known ontology business.
Yeah.
Mm-hmm. So,
the only one.
I mean, I think this AI move is here, and it's real, and it's having a massive impact. And I think what's going to be very interesting for the overall productivity growth down the line is going to be these data centers are being built right now. This is why you're seeing Caterpillar's doing so well, and some of these other companies. On Semiconductors up 8% this morning on earnings. And the question then becomes is, if we have these gains from AI already that Palantir is benefiting from, what are going to be the gains in the future once all these data centers come online? I think it's going to be pretty remarkable.
Yeah. We'll get SpaceX earnings tonight, Tom. So something to look forward to.
Strap in.
Yeah, I mean, there's really no telling. I'm very curious. One, obviously, what's reported, but just what's the market looking for? I mean, I think that's going to be interesting to see. We'll be able to recap that tomorrow. In the meantime, Merck up about 1%. They got a nice beat with Keytruda, but not necessarily a robust number. Pfizer essentially flat, not changing guidance. But McDonald's, let's talk about unhealthy companies, up 2%. A little surprised by that.
Yeah, I'm on the healthcare side. I think there might be some channel stuffing going in. Eliquis is Pfizer's biggest drug, and that's coming off patent at the end of the year. And then you just have a bunch of boring companies. McDonald's, traffic was down. I actually thought traffic was going to actually do okay, but traffic was down. Kimberly-Clark blaming. We talked about Procter & Gamble having one of the most boring quarters ever. Kimberly-Clark might rival that, except they wanted to throw a little drama in that. So they have this thing called For Media, or something that's apparently all over the China social media, which I didn't know China had social media, but apparently they do. And apparently it's dramatically impacting sales of their Huggies diapers.
Ooh.
So file that away as something that you can tell your friends about.
Wait till they hear about Stanley Cups.
Man, they're going to lose their mind.
So, but really, I mean, in terms of what we own and what we're doing here at Narwhal, I think that obviously the AI side is definitely something that we're trying to figure out. We have some equipment rental companies, Sunbelt. We have some Caterpillar in some accounts. We have some Integris, which is doing very well this morning. They provide a lot of the equipment for semiconductors. We have Analog Devices, which made a genius acquisition of Empower Semiconductor.
For what,
$1.5 billion just a month or so ago. So we're definitely interested in kind of what's going on there. We're trying to measure the cycle. We don't want to invest in the Cornings of the world that can be a flash in the pan that trade at 80 times earnings for a glass company. But we do think there are some durable trends. I mean, even in Caterpillar, I think that's a little bit more durable. We did have a question, Tom, about the cost of debt and if there's a lot more supply coming to market because of all this capital raising on the debt side. I mean, Skyworks is now going to raise capital to fund its acquisition of Corvo. We see these deals for Blackstone and BlackRock all the time, financing data projects. The question was basically, are you seeing an impact on the supply side of fixed income right now?
I mean, we're seeing
rates high.
I mean, there's so many names that are really getting popped. I mean, I think the easiest one to look at just as an ease of use case is Oracle. They were really the first mover in the massive issuance of debt. That was probably 6 months ago, maybe a year ago.
Yeah, probably closer to a year.
Yeah, they were starting to really roll out debt. They're like, we got to build out. We're going to issue all this debt. So for context, like I just pulled up the Oracle's of 2036. So those were issued at par at 570. So at the time, these were probably 4 months ago. They're 10-year bonds. They peaked a couple weeks ago at a yield of over 7. So they're getting sold off. So in theory, if you were just to buy an Oracle bond that matures in 10 years, you were looking at a 7% yield, which is, call it 250 basis points over at the time, the 10-year treasury. I mean, that's pretty big spread considering triple B spread right now is kind of in the, 140, 120 range. I mean, they're pretty tight spreads despite the fact that all bonds are selling off. So that's rebounded really quickly the last couple of weeks. They're sitting at like a 665, but it's still... And that's the investment grade tranches. So you've got to start adding spread on top of that as you go down, towards the private credit range. So, I mean, my guess would be they'd be in the 10, 12, 13% range on some of this stuff. And I don't know that they're not money good, but if they aren't, you're not going to get anything for them. And there's going to be a lot of trading of hands just to try and keep passing that along. And I think that's where a lot of people have run into trouble is that even at those levels, people don't really feel that appetite for risk, particularly when you can buy a stock like Caterpillar and it can be up 10% a day.
And I think for me, and Tom, weigh in on this because you're certainly more well-versed in managing fixed income portfolios and fixed income allocations within a more broad portfolio. But for me, part of the way the question was phrased is this mass issuance essentially putting pressure and diluting interest in treasuries? For me, I would almost argue no, and that I'm looking at something very different if I'm looking at something down the scale from Oracle versus a treasury. I have a different return objective and a different risk profile, which can't be decoupled from that if I'm looking at some of these opportunities that are being used to basically lever up and build data centers.
Yeah, I mean, it's almost the opposite. The things that have gotten popped the most in the last 60 days are the highest investment grades. So you think treasuries and mortgages. And then in terms of munis, I mean, munis had the worst month in July than they've had since 2004. I mean, they're down almost 3% in a single month. And so then it becomes almost like these are actually less valuable now. I mean, at 660, now that we are at the 10 years at a 465, you've actually gotten 200, or you're getting 50 basis points less in spread by buying this Oracle bond, which has a lot of hair on it, versus buying a treasury. So why would you not just buy a treasury? I think what's really happening is there's so much supply in bonds everywhere that the nuance starts to fade. It kind of just becomes, sell everything, avoid everything, because you've got, I mean, Oracle, Google, Meta, there's a bunch of SpaceX bonds that were issued that have immediately traded way down. I mean, there's just debt out the nose that it's just kind of like there's so much of it that there's just not enough demand for anything. And so the cleanest stuff is the stuff you can sell the easiest. And so it's actually performing the worst because you get the most sell pressure there. Everybody else is just kind of along for the ride.
You think about all the money that's been in money market funds, which is de facto in treasuries, that now needs to come off the sidelines to buy this debt of this corporate debt. And so, I mean, to your point, Tom, I think that there's also a lot of sovereign debt that's coming out. I mean, Germany's got rid of its fiscal mandates. We're seeing Japanese debt really sell off. So that's becoming more attractive as a competition for the
Do we
US.
have a good read on, we talked at the beginning of this year, Ben and Tom, on the amount of money in money market funds that would need to be deployed or presumably could be deployed at least and come into play. Do we have a read on where that is?
It's still
halfway
pretty
into
much
the year?
at all-time highs, about $7.5 trillion.
Which is interesting as you think about the market dynamics, because we've talked at length, specifically on the equity side about the amount of issuance and the amount of market cap that has come to the table, and yet we're sitting here, the market's up 10+%, and that money really hadn't moved.
Yeah, I mean, we haven't, I guess on the IPO side, we haven't really seen a lot of that be unlocked yet. It's kind of that initial, like if we're talking SpaceX, it's like it's 80 billion. It's not 2 trillion yet.
Yep.
That'll happen over the next year.
2 days is when the first unlock. 20% of shares unlock on the 6th.
So I think that's a piece of it. But then also on the private side, I do think that private equity and private credit exists to basically arbitrage each level of they call financing. And so I can issue a private credit note of 13% on certain debt, and then basically refinance that with, and just kind of work down, like tranche that out. And then at the end of the day, the funding currency essentially is treasuries. And so even though you're issuing Oracle debt or private credit debt, it ultimately becomes a treasury. Yeah. I mean, because the private equities, say, okay, we can finance this at 2 to 1 and this one at 1.5 to 1. And then ultimately you arbitrage that risk such that they're funding their purchases of the private credit at 5%. And that's how they make money.
Yeah.
I mean, it's such an interesting environment right now, because the irony is if they cut rates, you'd probably see rates go down because people would move out of money markets. But 375 still seems to be a level in which people are perfectly comfortable, despite the fact that there's infinite opportunities for 3, 4, 7, 10-year bonds at, in some cases double that return without really taking a lot more risk. But people are perfectly happy because they went so long getting 10 basis points on their checking account that 375 is pretty nice. Yeah, and they get to keep that cash.
If you were wide awake from 2008 through 2022, and then you took a 3-year nap and you woke up and said, "Hey, we've got 375 on a money market," you'd be like, "That's sick."
Yeah,
and it's beating fixed income year to date.
Yeah,
but I mean that could change overnight.
Yeah,
and then
that's why they call it the overnight rate.
Makes you think. That's exactly why they call it that. All right, good stuff. We'll wrap it up there. We'll be back tomorrow. Y'all have a great day.